And we are live and we are back. Let's go. I'm Cory, your host, one half of the Cory and Full Effect podcast. And I'm back like I never left with another installment of Wealth Wednesdays. Here on the Cory and Full Effect podcast, we discuss health and wealth, finances and fitness, and everything in between. And we want to make sure you save more and save less and keep making better your best. Yes, yes. However, my co-host Jordan, when he was on, he's off of paternity leave. So now he is back and we have started doing the full Court and Full Effect episodes, live streaming them on Sundays, every other Sunday. So this Sunday is when we'll do one as far as the 12th. Yeah, whenever the Super Bowl is. But I started doing Wealth Wednesdays while he was out on paternity leave, and I have kept those going. But before I get started, make sure y'all hit that like button. Please share and subscribe. Please help out the YouTube algorithm on the podcast platforms. Leave those rate and reviews as well. If you would like fitness information, please follow Jordan at Stop Stalling J. That's Twitter, Instagram, and TikTok. His business page is FinallyFit06 on Instagram, and I believe it's just FinallyFit on Facebook. And his website is FinallyFit.live. Jordan does offer virtual classes on Monday and Wednesday at 5:30 a.m. Yes, I said 5:30 a.m. Those are more the intermediate to advanced classes. If you don't think you're ready for those, you're just getting started on your fitness journey, then he does offer classes on Tuesday and Thursday at 6 a.m. for beginners. And then for those of you in the Hartford County area or willing to travel to the Hartford County area, Jordan does do in-person training. I'm not sure if he's booked up on that, so please reach out to Jordan. Right, he's not going to help 100,000 people. But if you're interested in in-person sessions, not virtual, and you want to go to Hartford County, Jordan is willing to coach you in person or training. I guess it's training. I do the coaching. Financial coaching information is in the show notes. It's on my link tree as well as far as Instagram and is Instagram and Twitter. Yes, but I'm silent_Cory on Twitter, Instagram, and TikTok. Financial coaching, $50 for one hour session a month and $100 for one 1 hour session a week. But we get straight to it on the Wealth Wednesdays. No bluff, no filler, no bluff, no filler, no fluff, nothing. Shout out to student loans starting the hearing on February 28th. Today's the 9th. I know today is Thursday, not Wednesday. Again, work is still being busy. I was going to record last night as far as Wednesday and drop it. I'm like, let me get back on recording in the morning. Let me get back on that schedule. So today is Thursday, but it's still Wealth Wednesday. But as you can see for the title, we about to talk about retirement. Is your retirement secure? So for those of you who do not know what the Secure Act is, let me share my screen here while I'm struggle streaming. Secure Act was signed by President Trump. I think it's 2019. Let's see what Wikipedia says. Yeah, in 2019. And it stands for more government acronyms. Setting Every Community Up for Retirement Enhancement Act of 2019. So again, President Trump signed this office in 2019. In short, it did a lot of changes to the retirement process, as you can imagine, right? Setting everybody up for retirement. However, that was the first one, or 1.0. We now have a 2.0. So today, and shout out to my favorite brokerage, Fidelity, we're going to go to Fidelity for an article. Okay. No CNN, NBC, none of those. We're going to one of the largest. I believe they have the most 401k plans and the most 401k money. I don't know exactly what that metric is, but Fidelity, one of the largest brokers. Some say it's the best when you talk about everything that you look for from a brokerage, but Fidelity, a top dog on the investing house. We got an article on Secure 2.0 that President Biden signed as far as an update. So it says here Secure 2.0, rethinking retirement savings. So earlier this year, at the end of last year, I did an episode as far as updating on all the different the increases to the IRA, going from 6,000 to 6,500, the 401k increase, all those type of things. This is going to be an increase to a bevy of things involved in your retirement and things you can do with it. I think there's about 9 or 10 points. So we're going to go through all of them to get you guys updated. Now, again, this is retirement stuff. So, if you're my age, you're already turning 30 this year. If you're a millennial, this isn't going to impact you directly, but there is some stuff in here as far as some, I said, short-term / long-term future planning, like in the next 10, 15 years, depending on when you're at. There's some stuff in here about 529s that is pretty interesting. So, again, things can change, right? And they will change in 40 years, but this is some good information to know so you know how you can continue to use your retirement to your advantage. And there's a 5-minute read. Am I going to get somebody to the article? Let me scroll to the bottom real quick. All right, I don't see a name. Okay, and if you don't know this is your first time listening, I always struggle with the names of these authors of these articles, but this just says Fidelity Viewpoints. So here's some key takeaways. Let me see. That's not zoomed in enough for y'all. My bad. Never been on this website before. Here we go. That's better. All right, key takeaways. The age to start RMD, that is required minimum distribution, it's increasing to 73 in 2023. So this year, wow, 75 in 2033. So RMD, required minimum distribution age, in short, that's saying once you hit 73 for 2023 or 75 in 2033, you're required to take a minimum distribution out of your 401k. So you can't just leave the money sitting there forever. Now, if you have a Roth IRA, you can leave that money sitting there indefinitely. The issue is you haven't paid the taxes yet. 401k, right? His tax deferred account. Government wants their tax money. That's my reason thinking they have an RMD. So you're going to be required to take that money out again. Millennials, right? 73, 75. That you're not hitting that no time soon. But it's something to be aware of for your grandparents or your parents. We're talking about that generational wealth, that wealth building, that legacy, talking about trust, estate planning. This is something to be aware of as your parents approach or your grandparents are about to hit that age. The penalty for failing to take from your RMD is going to decrease from 25% of the RMD amount to 50% currently. It's going to increase to 25% from 50% and 10% if corrected in a timely manner for IRAs. That's going to be traditional IRAs, maybe even simple IRAs as well. Okay, in 2024, RMDs will no longer be required from Roth accounts. See? And employer retirement plans. Again, so remember I said the Roth IRA. Remember, Roth just means the money you put in is post-tax. 401k can still have a Roth designation where you put the money in post-tax, but this is saying there will no longer be an RMD after 2024 for the Roth 401k accounts, right? It's employer retirement plan, it's 401k, 403b, whatever your employer has set up for you. Also, as well as a quick note, RMD it's not a fixed number, it's a calculation. This is going to be different for everybody. Catch-up contributions. Again, we talked about this on the episode I mentioned earlier this year. It's going to increase in 2025 for 401k, 403b, and governmental plans and IRA account holders. So it's going to increase again in then catch-up contributions. Okay. So right now the catch-up contribution is still $1,000, I believe, for IRAs, and it is $6,500, I believe, for 401ks. So they're saying not next year, but the year after 2025 it's going to go up. Catch-up contribution age is 50, and it's the year you turn 50. So even if your birthday is December 30th or 31st this year, the fact that you turn 50 this year, you can start putting in money towards that catch-up contribution right away. Defined contribution retirement plans will be able to add an emergency savings account with a Roth account. Okay, interesting. Secure 2.0 is now law. Legislation provides a slate of changes that could help strengthen the retirement system and Americans' financial readiness for retirement. I'm also going to do my best improving my podcasting skills, my live streaming skills. I'm going to start doing my best to highlight more frequently what I'm reading, because I was watching some of the playbacks. I'm like, where am I reading at? So I'm going to do my best to always highlight just part of the section. Law bills on early legislation, again, as I talked about, that increase the age at which retirees must take the RMD and allow workplace saving plans to offer annuities, capping years of discussions aimed at bolstering retirement savings through employer plans and IRAs. So they've been talking about this, I guess, for years now. Shout out to the crazy high inflation. So they're making some adjustments, I guess. Okay, saying Secure 2.0 contains dozens of provisions. We're going to highlight the increasing age at which, retirees must begin taking RMDs, which is a big deal, from IRAs and 401ks, and changes to the size or a catch-up contribution to older workers. Additional changes are meant to help younger people. Here we go. So millennials, younger people, continue saving while paying off student debt to make it easier to move accounts from employer to employer and to enable people to save for emergencies within retirement accounts. So shout out to this, interested to see what the student debt changes. Then they're talking about having a savings emergencies for your retirement accounts. All right, because a lot of people already use their retirement account as a saving. Y'all gonna take out that 401k loan. Oh my goodness. Okay, so here are 9 things Secure 2.0 changes for people in or near retirement. So I'm gonna go through this quickly, right? So this is just for your grandma, your grandpa, your parents who are nearing that retirement age. Again, 73 is going to be the RMD as of this year. So if you listen to this, it's already 73. It was Trump moved it to 72 in 2019. It was 70 and a half before Trump made that change in 2019. Again, it's going to be 75 in 2033. In 2023, the steep penalty, okay, like we said, that penalty for not taking out enough RMD is going to go from 50% to 25%, and the penalty is going to be reduced to 10% for IRA owners. Additionally, Roth accounts, again in 2024, Roth 401ks, excuse me, not Roth accounts, Roth employer retirement plans. When I say 401k, I'm just saying all employer retirement plans will not have RMD start in 2024. So in short, this is the last year. So hopefully you turn 72 this year. Let me pull up the calculator real quick and see what's that going to be 60. No, it's going to be 50. Is that going to be people born in the 50s? Yep. All right. So as long as you're born 1951 or after, your Roth 401k is not going to have an RMD. So at least you just got this 1 year. Though it's the last year. Additionally, Roth accounts. Okay, I already read that in the beginning. Look at me saying I was going to highlight. I didn't highlight. And beginning immediately for in-plan annuity payments that exceed the participant's RMD amount. Okay, yeah, annuity. Turning 72 in 2023. Consider when you take your first RMD, either by December 31st of 2024 or delay until no later than April 1st, 2025. Okay, just saying how you can use this to your tax situation. Okay, again, catch-up contributions are going to change in 2025. Individual ages 60 through 63 years old will be able to make catch-up contributions up to $10,000. My goodness. Oh, it's up, I guess, annually to a workplace plan, and that amount will be indexed to inflation. The catch-up amount for people aged 50 and older is currently that's my bad. It's 7,500 this year, not 6,500. So they're gonna turn to 60 to 63. So right now, if you're 50 and up, is 7,500 for an employer plan as far as your catch-up contribution limit. They're saying for people between 60 and 63, which is interesting. What happens if I guess retirement 65, right? So shout out to 64, I guess. But they're going to give you another 2,500 from the 7,500, and obviously, like I said, they're saying it's going to be indexed to inflation. So as inflation increases, they're going to raise it as well. That's an extra 2,500 to 10,000. That's over. It's 22,000 right now for the limit for 401k limit without the catch-up contribution. It's over $30,000. Sheesh. So they're going to allow you those 4 years, 60 to 63, to put in over 100,000. My goodness. That's if you got that money. $32,000, divided by 12 months, almost 3,000 a month. So if you got $1,500 a check, in your 60s, go ahead and load it up. Caveat: if you earn, okay, here's a caveat. One caveat: if you earn more than 145K in the prior calendar year, all catch-up contributions at age 50 or older will need to be made to a Roth account in after-tax dollars. Individuals earning about 45 or less, adjusted for inflation going forward, will be exempt from the Roth requirement. This is why it's key to understand your tax situation so you can do everything you can to lower how much you're getting taxed on so you don't get hit by some of these rules. IRAs currently have, right, $1,000 catch-up, what I was talking about, at 50 in 2024. That limit will be indexed again to inflation, and meaning it could increase every year based on federally determined cost of living increases. So inflation / COLA cost of living adjustment, it was 8.7, I believe, last year. My goodness, almost 10%. Matching for Roth accounts, employers will be able to provide employees the option of receiving vested matching contributions to Roth accounts. Okay, that's great. Matching for Roth accounts. Employers will be able to provide, because I'm reading this now for myself, the employees the option of receiving vested matching contribution to Roth accounts, although it may take time for plan providers to offer this and for payroll systems to be updated. Okay, that's major. Is this only for retirement? For people near retirement? I can't tell if this is. Okay, this is still for people nearing retirement. I don't see an age on this. Okay. So when everybody talk about get that free money, you should take your make sure you invest up to getting your employer 401ks matched. So you got to invest 5% to get 4%. That 4% or whatever it is that your employer is investing for you, that money is always going to be put into a traditional 401k. In short, even if you have a Roth 401k, whatever your employer contributes or matches, that is going to be put into the traditional 401k account or whatever the employer account is, 403b, whatever. This is saying your employer will be able to give you the option just like you have the option to choose a Roth 401k or traditional 401k or whatever it is, they're going to have the option so that they can actually receive that vesting amount to Roth accounts. That's very key. That's major. Previously, matching and employer sponsored plans are made. Okay, I don't read ahead, but I just said this. This is literally telling you what I just said. Previously, your employer sponsored plans, they were made on a pre-tax basis, aka your traditional 401k, 403b, whatever it is. Contributions to a Roth retirement plan are made after tax, after which earnings can grow tax free. See, the great thing about this is not only does the Roth help you better plan your tax situation at retirement age, because that money's not taxed at all. The money that you put in, if you choose traditional or a Roth, let's say you're contributing 5%. If you do the traditional, you get that tax benefit right now because it deducts from your taxes. If you choose the Roth, you're paying the taxes right now. You don't have to worry about paying taxes when you withdraw the money, as long as you meet the requirements, retirement age, etc. What your employer does, you don't get the benefit from a tax standpoint. So in short, you can pay the taxes right now and get it over with, and don't have to worry about it when you get to retirement. Important to know, it's going to contradict me. Unlike Roth IRAs, RMDs from an employer-sponsored plan are required from Roth accounts. Okay, they're saying, okay, it's what we said earlier. So like I said, Roth IRAs, not Roth employer accounts or employer-sponsored plans, but Roth IRAs do not have an RMD, so you can leave that money in there indefinitely. Obviously, if you die, then the money's got to be taken out in 5 years, something like that. Regardless, though, until tax year 2024. I don't know if this is saying meaning 2023 is the last year or 2024 is the last year. Qualified charitable distributions, or QCDs. Okay, starting this year, 2023, people who are age 70 and a half and older may elect as part of their QCD limit a one-time gift up to $50K, adjusted annually for inflation. Shout out to them, they letting us know they adjusting stuff for inflation, to a charitable remainder unit trust, a charitable annuity trust, or charitable gift. This is an expansion of the type of charity or charities that can receive a QCD. This amount counts towards the annual RMD if applicable. Okay, for gifts to count, they must come directly from your IRA by the end of the calendar year. QCDs cannot be made to all charities. That's just letting you know. Other changes, annuities. What is it? Qualified longevity annuity contracts are getting a boost too. So if you got annuity, deferred income annuities purchased with retirement funds, typically held in an IRA or 401k, that begin payments on or before age 85. If you live long enough, shout out to the fitness section. Make sure y'all working out, eating as healthy as you can that you can afford. I remember 150 minutes a week. The dollar limitation for premiums increases to 200K from about 45K starting January this year. The law also eliminates a previous requirement that limited premiums. Okay, you guys don't care about annuities. For people years away from retirement, here we go. So we're almost done with this article. Automatic enrollment and automatic plan portability. I made this joke saying y'all didn't even elect your 401k contribution. Your job just did it for you. Like, you're investing, but you didn't even choose to invest. Legislation requires businesses adopting new 401k and 403b plans to automatically enroll eligible employees starting at a contribution rate of at least 3%. Man, they are trying to make sure people have money when they retire. My goodness. This is starting in 2025. It also permits, and it's saying new plans. So this sounds like if your job may switch over, if it's, a new business type of thing. New plans isn't very clear. It also permits retirement plan service providers to offer plan sponsors automatic portability service, transferring an employee's low balance retirement accounts to a new plan when they change jobs. So in short, whenever we talk about doing a rollover, make sure you always do a direct rollover, not an indirect. But all it's saying is it's going to make it easier for you to move your previous account over to either a current one. As far as you leaving job A and you got a new job at job B, you can take your job A requirement and they're going to make it easier to move that job A retirement to job B's retirement. I still recommend, it's different for everybody, but at some point in time, you're going to have to do the rollover IRA, right? Take that money with you, just so you got it all at one place, because you don't want, you get fired from your job or something like that, and now you got to work with your old HR department, to get your retirement money. The change can be especially useful for lower balance savers who typically cash out their retirement plans when they leave jobs. Don't do this. Do not do this. I don't care how low it is. Don't cash it out when they leave jobs rather than continue saving. Yes, don't do that. Emergency savings. Here we go. Defined contribution retirement plans would be able to add an emergency savings account that is a designated Roth account for eligible to accept participant contributions for non-highly compensated employees in 2024. Here we go. They put an income limit on it, non-highly compensated employees. So for those who are in a situation where you make over six figures and you're living paycheck to paycheck, this is probably not going to help you because you're not going to be viewed as non-highly compensated as a non-highly compensated employee. This is starting next year. I'm going to get defined contribution. This is a very wordy statement. Defined contribution retirement plans would be able to add an emergency savings account. All right, contributions will be limited, Jesus Christ, to $2,500 annually or lower as set by the employer. This is useless. I mean, it's better than nothing. It's better than nothing, but $2,500 or lower. And the first 4 withdrawals in a year would be tax and penalty free. So are they? I don't know if they're saying this. If you're going to be able, that is, it's got to be a Roth account. Okay, so you're paying the tax. Okay, this is useless. Always remember the Roth account. Remember, you're paying the taxes ahead of time. So in short, if you have a Roth 401k, that's literally all the taxes, your pre-tax deductions, your health insurance, things like that. All that comes out. HSA, whatever you're doing, FSA, and then you put that money in your Roth 401k, and that's essentially your check. So let's say you get paid $1,000 and you end up putting $100 in your Roth 401k. You technically got paid $1,100, and then $100 of those dollars never your bank account went straight to your Roth. So your Roth 401k, from a tax standpoint and how much you get paid, you would get paid the same amount of money if you chose not to invest at all. As far as not doing the Roth, not doing traditional, just taking that. So this person who makes $1,000, if they just didn't do their contribution at all to their Roth 401k, they just make the $1,100 because that $100 is already Roth. It's already been taxed. So this is saying the account has to be a Roth account, and so you already have to put the money you're putting in is already your money essentially. So if you're going to put $2,500 up to in this account, just put it in your own savings account, and because they're saying the first withdrawals be tax and penalty free. If you got a $2,500 cap, my guess is this might continue to go up every year as far as you can roll the money over. But I mean, how many times are you going to take for 4? How many times are you going to take from 2,500? 4 times? My goodness, what is that? What is 25 divided by 4? So yeah, so you can say $625. My goodness. Oh my goodness. Depending on plan rules, contributions may be eligible for an employer match. Wow. All right, you might get some employer match in here. In addition to giving, I hope that doesn't take away from your actual retirement employer match though. In addition to giving participants penalty-free access to funds, an emergency savings fund could encourage plan participants to save for short. Yes, true. I mean, the savings, 2,500 though is a lot in the sense of, I think it's damn near 60% of Americans don't have $1,000. So 2,500 isn't a bad number. It's over 2.5 times. It's 2.5 times. So it's more than double the 1,000 that most people don't have. So that in and of itself, from the data, is not a bad number. It's actually, most people probably aren't going to hit that. But be interesting to see how that employer match situation works for your savings. Just give me more money instead of putting me. Put it like this: if your employer is going to say, "Hey, we're going to put some money towards your savings account," why don't you just give me that money in my check? Like, my goodness. In addition, and they're probably getting a deduction for it though. Okay. In addition, like I said, giving participants penalty free. Like I said, yeah, it's going to encourage people to save more for short-term expenses. Just get on a budget, build your savings. Shout out to Dave Ramsey plan $1,000. Save you $1,000 or $2, something like that, and then get started on paying off your debt. Most people's issue is not only just a lack of savings, but they got too much debt, and all those debt payments kill them. It's not even death by 1,000 paper cuts; it's death by like 1,000 butcher knives. And so you don't have no cash flow. That's the real issue. Here we go. Student loan debt. A very short sentence. It was 2 sentences here. Starting in 2024, employers will be able to match employee student loan payments with matching payments to a retirement account, giving workers extra incentive to save while paying off educational loans. God, they're going to make y'all pay off the student loans. They're going to make y'all put money towards these student loans one way or another. This is saying your employers will be able to provide a match. And I believe this number was up to $2,000 or $3,000, something like that. So in short, what this is saying is that you as an employee, you can make payments towards your student loans. And let's say you put $100 towards your student loans, your employer will be able to match that payment, but they're going to put it in a retirement account. They're not going to put it towards your student loans. I know it's kind of tricky here. They'll be able to match employee student loan payments with matching payments to a retirement account. So in short, however much money you put towards your student loans, your employer is going to match that. But they're going to put that money, that match, into a retirement account. So they're going to make y'all pay off these student loans. And last but not least, again, the 529 one, this one's very important as well. 529 plans. After 15 years, 529 plan is a college savings account. After 15 years, 529 plan assets can be rolled over to a Roth IRA for the beneficiary, subject to annual Roth contribution limits and an aggregate lifetime limit of $35,000. Rollovers cannot exceed the aggregate before the 5-year period ending on the date of the distribution. This is just more jargon. The rollover is treated as a contribution towards the annual Roth IRA contribution limit. This is very key. So a lot of times when people have 529 plans, they worry about overfunding them. Now, the benefit of a 529 versus an ESA, which is another college savings account, that the ESA, let's say you have ESA for your son or daughter, that money has to be used by your child by the time they turn 30. Okay. For a 529, that money can stay there as for however long they want to sit there. If they want to go back to school when they're 45, they got the money in there, they can use it. Not to mention you can open up an ESA for your son, and then your son can have a kid and they can move that over to your grandson. So there's not a clock on the 529 like there is with an ESA. But a lot of parents are worried, which doesn't happen, but oh no, I've overfunded their college savings account. Well, this is saying 15 years. So in short, around their 40s, right? Graduate college, right? 22, 23, might get your master's, right? So around your late 30s, early 40s, right? 15 years, those assets inside the 529 can be rolled over to a Roth IRA up to saying 35,000. My guess is this probably isn't going to change too much. This isn't like a multiple, because right now the limit is 6,500. So this is a little around little under 6 times. So who knows, this 35,000 might increase, but that's very key. So this is going to allow you to even more of an incentive to put money into the 529, because hey, your kid doesn't want to go to college and y'all don't want to take the money out and pay the taxes on it. Your kid does go to college, still got some money left. Your kid doesn't want to have kids. All these different type of things where people worry about having money in their 529, how to access it and not having to pay the taxes on it. They're saying, hey, 15 years, you can put it inside the Roth IRA for your beneficiary. So for usually your son or daughter. It's saying after 15 years. 15 years of what? When they graduate, or 15 years after they turn 18? I don't know what the after 15 years is. But as a wrap up, while Secure 2.0 provides increased opportunity to save for retirement, everyone's financial situation is different. Yes, that's why it's called personal finance. As always, consult your financial advisor or tax professional to understand how Secure 2.0 changes apply to you. Okay, that's it. So again, as a recap, for those of you who have parents or grandparents near that retirement age, RMD, require minimum distribution, which is going to make you take out money at a certain age. It's up to 73 this year, and it's going to be 75 in 2033. They're reducing the penalties for it as well if you don't take out enough money. Catch-up contributions are going to increase in 2025. For people 60 to 63, it's going to be up to $10,000. Right now, if you're 50 and up, it's up to $7,500. Matching for Roth accounts, so they're saying that your employer is going to be able to put money into a Roth 401k or Roth 403b, whatever the employer, sponsor plan is, instead of putting into the pre-tax account. Then if you got annuities, I'm going to skip over that. Most people don't have that. Then for those of us in that millennial age range, automatic enrollment. So in short, starting in 2025, you're going to be enrolled at 3% automatically by your employer. So you're going to have to change that, right? If you want to. That 3% is going to get you, for most people, a good amount, if not all of your employer match as well. Emergency savings, they're going to allow you to have an emergency savings or a Roth account. This isn't really that beneficial. It's going to be up to $2,500 or lower. That's going to be determined by your employer. And you can do 4 withdrawals a year without paying any taxes or any penalties. in short, since it's a Roth account, just save. Don't put the money in the account. Just save this money on your own. Because if you're gonna put the money, if you're gonna put up to the 2,500 in there, why are you gonna put yourself in a situation where you can only do 4 withdrawals? This is the same. This is the same thing as a savings account, except you're putting yourself with at risk for taxes and penalties once you do 5+ withdrawals. My goodness, student loan debt. Your employer is going to be able to match your student loan payment into a retirement account. So let's say you're putting $100 on your student loans. Your employer is going to be able to match that, but put $100 into your retirement account. Again, all this matching stuff, not sure how it impacts already the match that employers normally do. They didn't say anything like that in here. So they're going to make y'all pay these student loans. That's what they're going to make y'all do. They're going to make y'all do that. And they're going to say, hey, you could have paid your student loans and have money, more money in your retirement accounts. Like, my goodness. Then last but not least, the 529 plan change. Once it's the same 15 years after. I don't know 15 years after what, but that's likely going to be your late 30s, early 40s. If you have a 529 and it's overfunded, all the money was not used for college for your child, after 15 years, you can roll that money over into a Roth IRA up to $35,000. Okay. So Secure 2.0, a lot of big changes again for millennials. The main thing you're going to be looking at is, I skipped over this too. They're going to make it easier for you to move your retirement accounts from an old employer to a new employer. Emergency savings one. This is probably the worst thing on here. I would not recommend using this because you do not want to be at risk for taxes and penalties on your own money. It's different if it was pre-tax money. Okay, makes sense. But this is Roth money, so you already pay taxes. This is literally just your money. I would not use the emergency savings. Make use, obviously, if you're changing jobs. This is in 2025 though, of moving your old 401k or whatever retirement plan over. For those of you got student loan debt, going to want to take advantage of this if your employer offers it. A lot of employers already do some type of student loan assistance. Not a lot, but more employers are starting to offer that because so many people have student loan debt. And then obviously the 529 plan, if you're looking at starting that, you got some more leeway now if you do happen to overfund it. Although we did talk about how much college. Did I say how much college is going to cost in that student loan episode? The projected numbers are anywhere from $300,000 to $500,000. Let me see. How much will college cost in 18 years? Look at this. I'm not zoomed in enough. How much will college cost in 18 years? And how much your 4-year degree is estimated to be $442,697.85 for students enrolling in 2041. That's unreal. If tuition increases average 7% per year until then, that is unreal. That is an unreal amount. Oh my goodness. But all right, y'all, again, shout out to the Secure Act 2.0 update. Again, those are great changes by both President Trump and President Biden adding on to it. These are things you definitely are going to want to take advantage of depending on your age. Again, make sure y'all hit that like button. I still got it up. See, I never take it off. Again, make sure you hit that like button, share, and subscribe. Shout out to the YouTube algorithm. Make sure you leave those rating reviews as well on the podcast platforms. Again, my co-host Jordan, who does the fitness information, is Stop Stalling Jay on Twitter, Instagram, and TikTok. Jordan's business page is FinallyFit06 on Instagram, and then FinallyFit, I believe, I need to figure out what it is, but I think it's FinallyFit on Facebook. Jordan's website is FinallyFit.live. He offers virtual classes at 5:30 a.m. Yes, 5:30 a.m. Monday and Wednesday for intermediate and advanced. But if you're just getting started on your fitness journey, Jordan does offer beginner classes on Tuesday and Thursday at 6 a.m. Yes, virtually at 6 a.m. Then for those of you willing to travel or who live in the Harford County, Maryland area, Jordan does do in-person training. He does have some clients, so if y'all want to get on a schedule, because he can't, train everybody, it's a fixed amount of time, make sure you reach out to him. For myself, I'm _Cory, Twitter, Instagram, and TikTok. My financial coaching information is in the show notes, as well as on my link tree on Instagram and Twitter. But it's $50 for one 1-hour session a month and $100 for up to one 1-hour session a week. All right, is that better? Because we got feedback saying we need to do better at our advertisements and slow them down stuff. But all right, y'all. So again, any questions, concerns, always reach out to us. But y'all know how I close out. Make sure y'all save more, say less, and keep making better your best. And I will catch y'all in the next one.